Something important is happening in the silver market as we head into 2026, and it's being widely misunderstood. Most people are watching price bars. Very few are paying attention to who is gaining access. Behind the scenes, capital with priority status is moving first. Large pools of money are securing physical silver well before it ever reaches the retail market. Mario Innecco has been clear on this point. By the time most individuals see confirmation on a chart, the metal itself is already spoken for. That's why waiting endlessly for the perfect dip is becoming a dangerous strategy. In a tightening market, hesitation doesn't protect you, it leaves you behind. The surge we witnessed in 2025 wasn't a speculative burst that burned itself out. It was a repricing. Silver didn't inch higher, it reset expectations. And the forces behind that move haven't eased. Inflation gets the headlines, but the real pressure comes from availability. Mine supply has lagged demand for years. While much of the existing metal sits in places that are hard to reach, expensive to recycle, or held by owners with no urgency to sell. According to Innecco, that imbalance doesn't resolve through time. It resolves through price, and usually at levels that surprise nearly everyone. Yes, volatility will remain. Pullbacks will be sharp, but those moves don't create silver. They only clear out leverage. Underneath the noise, longer-term signals continue to firm up. Silver is no longer following gold's lead, it's setting the pace. Historically, that shift appears near the beginning of powerful metal cycles, not at the end. When viewed against broader financial assets, precious metals still look early rather than exhausted. Then there's the global divide. In Asia and across parts of the Middle East, silver is treated as a physical input, not a paper trade. Prices there are shaped by delivery, ownership, and necessity. Demand tied to infrastructure, energy systems, and industrial expansion continues pulling metal eastward, while Western markets remain heavily reliant on derivatives. As margin rules tighten and leverage becomes more expensive, paper pricing is being forced closer to physical reality. So this isn't just about where silver trades today. It's about where real demand is setting the terms. And that leads to the question investors can't avoid much longer. If price discovery ultimately belongs to the markets where silver is actually required and removed from circulation, not merely traded on screens, how long can the current disconnect hold before it breaks? Before we jump in, if you appreciate these deep dive market breakdowns, please take a moment to like the video and subscribe. It helps this analysis reach more people while it still matters. I'd love to hear from you in the comments.
It's not just because of inflation, it's because of the supply, especially with silver. I know there's a lot of silver in the world from past production, but it's in places that is really hard to get and recycle. But so right now, yeah, there's a desperate rush to get physical silver. There's a huge shortage. We've seen the mining supplies not match the demand for the last 5-6 years. And that's why I think the price of silver needs to go up at multiples in order for people who have silver to get rid of it so that people that need the silver can get some. I personally, unless I need to, am not going to sell my silver. I'm going to hold on to it. But some people might. If we're at $300 silver in 2 months' time, I'm sure a lot of them will sell. But it's difficult to say at what price, Elijah, things are going to balance out in terms of supply and demand. So yeah, it's not just inflation. And we've been hearing, you probably heard of this rebalancing of a commodity index, that it was going to crash silver. And despite that, silver's already up roughly 20% this year. And we haven't even finished January. Gold as well is up a few percent. So I don't think it's going to stop this performance. Of course, there will be some sharp corrections along the way, and you just need to sit through those, I think. I always think of trying to get as much of both with my fiat. So, but if people have a lot of silver and they've done really well and they don't have any gold and they want some exposure, why not? Get rid of some silver to get some gold. I don't have anything against that. But the other important thing about the gold-silver ratio is that you and I and others in this space have always been telling people that for you to have a real raging precious metals bull market, you need to see silver outperforming. And that's what we're getting. So this is, I think, in my opinion, just the beginning. And I don't know how long it's going to take. If you look back to 1933 and 1980, when the credit cycle bottomed, the Dow gold ratio, in 1933 was 2-to-1, and 1980 was close to 1-to-1, and we're still just above 10-to-1, the Dow gold ratio. So I think there's still a lot of room in the precious metals bull market, especially relative to the stock market. China and India, they're buying a lot of physical silver. Also, the Gulf cooperation countries, which is like Saudi Arabia, UAE, Qatar, Bahrain, and Kuwait, they had a deal with China back in December of 2022 to cooperate in building their infrastructure. And it even mentions photovoltaics, which is for solar panels. So yeah, all these countries are buying a huge amount of physical silver. In the West, the LBMA and COMEX is more of a paper market. And I think that's why the price of physical silver in Shanghai is higher than the Western prices, because it's for real physical silver. And that's why the Chinese as well, they've put export controls since the 1st of January this year on exports of silver. And yeah, I think it's about $10 premium over in China. And then you can also, I mean, when you take delivery in China, you pay VAT. But Eric Young, who's also known as King Kong, he does a very good job of differentiating the price with VAT and the price without VAT. And even without VAT, I think silver's trading around $100. I think today it's sell about 101 on the Shanghai Gold Exchange. So that's why it's happening. It's because it's a real physical market in the Middle East and the Far East and in India, while here in the West, it's still kind of a hybrid, but eventually I think there's no way that the price in London and New York won't catch up to the price in China or even India. I think there's a 17% premium.
As you heard, Mario is pointing out something critical, because it explains why gold and silver are moving in ways most investors don't see. On the surface, it looks like political noise. DOJ investigations, Powell under pressure, headlines flashing on every feed. But underneath, it's stress. Stress in a system that can no longer operate cleanly. A system trying to manage inflation while debt continues to climb. A system where real capital quietly moves into physical metals long before the charts catch up. And here's the point. This isn't just short-term volatility. It's not about reacting to news or waiting for the perfect moment. It's about the growing imbalance between what the Fed signals and what the market actually needs, between paper promises and real-world demand for physical metal. This is where history matters. In 1980, Volcker could raise rates to 20%. The national debt was small. Derivatives were minimal. He could control inflation. Today, not possible. Debt is massive. Derivatives are everywhere. Interest rates are low. Money printing is constant. Trying to raise rates sharply now could crash the entire financial system. And this brings us back to Mario's warning. Even if the Fed is under pressure, even if Powell is being investigated, the fundamentals for gold and silver haven't changed. Debt is still growing. Currency is still being debased. Physical metal is still scarce. The risk of hyperinflation isn't a theory. It's a real possibility.
I think for Wall Street, and I've read about this, a lot of the major players on Wall Street, from banks, fund managers. They say it's a dangerous situation because it it chips away at the Fed's independence to set rates as they're supposed to contain inflation. Even though, Elijah, I think the Fed is an inflation machine, but the majority of people in the markets and on Wall Street think otherwise. But that's a different topic. So yeah, it's seen as infringement on the Fed's independence, and people worry that if Trump or the DOJ really goes after Powell, it gives a really dangerous signal in the future. It's not totally just about Powell, is about the next Fed chairman or chairwoman. They would be thinking twice before doing something radical to perform, the objectives that they should follow from Congress of maintaining price stability and full employment. So yeah, it's a danger, and I think it's one of the reasons why. Not the sole reason, because gold and silver were doing well anyway prior to the announcement from the DOJ. Yeah, and I know Trump has been pressuring Powell, but he's kind of left him alone right now. But even if we didn't have this attack on the Fed by Trump, I don't think the fundamentals for gold and silver or precious metals in general would change, because the underlying problem we have is too much debt, and that debt can only be serviced and sustained by even more debt being issued, or more reserves or money being printed by the Fed, and more borrowing done by the U.S. Treasury, by the U.S. government. So I don't think fiscal policy and monetary policy are going to go tight anytime soon. Of course, because most people are oblivious to the Fed's history. They probably think the Fed's been around since 1776 or something like that. So that's why. For you and I, it's like, go ahead and go after the Fed. It won't make any difference. You just have to look at a chart of M2 since 1971. It's going parabolic. So the Fed is doing a really bad job on inflation already. Yeah, in 1980, the derivatives market was minuscule, so there wasn't that hanging over the market. The national debt to GDP was about 35%. So Volcker could afford to let rates go up to 20%, short-term rates. I think the discount rate went up to 20%. And yes, it created a double dip recession. There was a bad recession in 1980 and later on in 81. He was able to bring inflation under control. And that's when the bond bull market started, because the 10-year yield had risen to 15%. And in 1981, and what he did there was quite. People say, well, yeah, it was the right thing to do, and he did well doing that. But many people forget that actually Volcker was involved in telling Nixon to close the gold window. He was, I think, deputy. He worked for the Treasury high up when they decided to close the gold window on August 15th, 1971. So, and then he went to the New York Fed, and then he became chairman. So he was basically kind of cleaning up the consequence, the mess that came about as the consequence of closing the gold window as well. But yeah, right now, if you try to let interest rates go to 6-7%, to really bring down inflation, the whole thing would come crashing. The whole economy, the financial system, because of quadrillions in derivatives off balance sheet. And of course, the CPI these days, Elijah, it's been tinkered with so much that it really doesn't tell us what the debasement of the currency is. So we might even need rates that are double-digit rates. I mean, you've got John Williams from Shadow Stats, who covers that. He looks at how CPI was calculated in 1980, and it was completely different than how it's calculated now. So that's why I think you were talking to me before we started that we have a danger of hyperinflation, and I think that's why, because there's no way that they can rein in the debt and contain inflation. If anything, they're going to keep fooling the public about what inflation is, and they're always going to find someone else to blame for it, like maybe Iran or China, but not the Fed, of course.
When you step back and connect everything unfolding in silver and gold, a larger story becomes clear. This is not just about price. It's about control. It's about scarcity. The markets built over decades were designed for convenience, not possession. Paper promises instead of physical metal, digits instead of ounces in hand, charts instead of certainty. For years, that system worked, as long as debt could be hidden, as long as supply seemed abundant. Now, the rules are changing. Scarcity is real. Physical metal is moving quietly into hands that will not sell. Demand is rising where metal is needed, not traded. And the gap between what exists and what is promised cannot last forever. Silver is preparing to break free. Not gradually, not politely. Its value will jump in sudden bursts. Pullbacks will appear, but they will clear the way, not stop the trend. Gold is rising steadily, quietly accumulating power. It won't spike as dramatically, but its climb is relentless. It is becoming a safe harbor amid uncertainty. This is the essence of the next phase, a shift from abstraction to reality, from reliance on paper to recognition of tangible ownership, from illusion to scarcity. And for those who understand it, action becomes inevitable. Holding metal is no longer speculation. It is independence. It is protection. It is refusal to be fully dependent on a system built for convenience, not security. So here's the question for you. Are you positioned to benefit from this shift, or are you still relying on paper promises while scarcity quietly reshapes the market? Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.